Your analysis was impeccable. The company's earnings were stellar, its new product was a marvel, and the analysts were all in agreement. You bought the stock, confident you had found a true winner. And then you watched, day after day, as it bled lower. It defied all logic. Each small morning rally was sold into, each piece of good news was ignored. You are holding a diamond, yet the world treats it like a stone, and your account is draining because of it. You are fighting an invisible enemy, a force you cannot see on the chart of your chosen stock. This force is the general market, and you have chosen to wage war against it. You will lose. The greatest single mistake a speculator can make is to be right on a stock but wrong on the market. It is a form of intellectual vanity. You have done your homework on a particular company, perhaps a copper miner with a new high-grade discovery. You know its balance sheet, its management, its extraction costs. You are an expert on this one small piece of the puzzle, and so you believe your specialized knowledge grants you an exemption from the larger forces at play. You tell yourself, this one is different. This one will rise even if everything else falls. This is the siren's song of financial ruin. The market is an ocean, and your stock is but a ship. A beautifully crafted, technologically advanced ship may handle a storm better than a leaky barge, but a Category 5 hurricane sinks them all. The novice focuses only on the quality of his ship. The master speculator first studies the weather. This error is rooted in a fundamental misunderstanding of how money moves. Capital flows like a great tide. When confidence is high and credit is easy, the tide comes in, lifting all boats. In these times, even mediocre companies with questionable fundamentals will rise. The public is buying indiscriminately, fueled by greed and easy stories. Conversely, when fear takes hold and capital seeks safety, the tide goes out. It does not selectively drain the water from around the weaker ships. It pulls all of them down toward the rocks. In a true bear market, the best companies fall and the worst companies are obliterated. Your job as a speculator is not to find the one stock that can defy gravity. It is to determine whether gravity is currently in effect. Arguing with the general trend of the market is like arguing with the rotation of the earth. You can believe you are standing still, but you are moving through space at a tremendous speed, carried by a force far greater than yourself. Ignoring it is an act of profound ignorance. Think of it as a campaign. A great general does not commit his elite troops to a battle without first understanding the overall strategic landscape. Is the main army advancing or retreating? Are the supply lines secure? What is the morale of the broader forces? To send your capital into a single stock while the market indexes are in a clear downtrend is to send your best soldiers into an ambush, deep behind enemy lines with no hope of reinforcement. They may be the finest fighters in the world, but they will be overwhelmed by superior numbers. Your stock's perfect earnings report is a single valiant soldier. The bear market is the opposing army. Do not send him to his doom. I remember a time years ago when the outlook for cotton was incredibly bullish. A drought in the South, combined with surging demand from mills in England, had created a perfect storm for higher prices. The charts for cotton futures were constructive, showing a clear pattern of accumulation. Every fiber of my being wanted to take a massive long position. It was, by all measures of that single commodity, a flawless setup. But I waited. I sat in my office watching the tape, and I did not just watch cotton. I watched the steel stocks. I watched the railroads. And what I saw gave me pause. U.S. Steel, the great behemoth, was failing to make new highs. Volume was diminishing on its rallies and expanding on its declines. The railroads, the arteries of the nation's commerce, were sluggish. Freight car loadings were down. Stocks like Union Pacific and Baltimore and Ohio were showing clear signs of distribution by informed interests. The tape was telling me a story that the newspapers had not yet printed. It was whispering of a slowdown, a tightening of credit, a general retreat of capital from risk. The bullish story in cotton was true, but it was a local truth. The universal truth, the one that governed all markets, was one of impending weakness. Had I bought cotton then, I would have been right for the wrong reasons, and ultimately very wrong. A sharp break in the stock market began a few weeks later. As it intensified, brokers sent out margin calls. To meet those calls, speculators who were long stocks had to sell whatever they could. This included their profitable positions in commodities. They dumped their cotton futures not because the outlook for cotton had changed, but because they needed the cash to save themselves from a financial blow-up in the stock market. A wave of forced liquidation hit the cotton pit, and the price collapsed. The beautiful bullish setup was washed away by a tide of fear that had nothing to do with cotton itself. My patience, my deference to the message of the general market, kept my powder dry. I waited until the storm had passed, until the general market had stabilized and turned up. Only then, when the wind was at my back, did I buy that same cotton. And the profits were substantial. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk a dollar of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. Understanding this flow, this underlying current, is the essence of speculation. It is what I teach. It is psychology. It is the ability to read the collective mind of the market. But psychology alone does not place the trade. My entire method was built upon identifying the line of least resistance, and that requires a framework for analyzing price and volume action. I give you the discipline and the mindset. But for the precise mechanics, exactly where, how, and when to execute the trade, you need the structure of Richard Wyckoff. He codified these principles into a repeatable, objective methodology. His work on accumulation and distribution, on identifying the behavior of large composite operators, is the perfect complement to my broader philosophy. I have left the link to his channel in the description below. Use it to complete your arsenal. Mindset and mechanics together are what create a master speculator. So how do you apply this principle today in front of your own screens? It is a simple yet profoundly disciplined top-down process. Before you even think about buying a single stock, you must perform this ritual. First, you analyze the major market indices. Look at the S&P 500, look at the NASDAQ Composite, look at the Dow Jones Industrial Average. What is their primary trend? Are they trading above their 200-day moving average, the long-term barometer of market health? Are they above their 50-day moving average, the intermediate trend? If the answer is no, you should be predominantly in cash or looking for short-selling opportunities. If the major indices are in a confirmed downtrend, your default assumption should be that any individual stock you buy is likely to fail. Do not search for exceptions, obey the rule. Second, you must examine the market's internal health. This is the equivalent of checking the morale of the troops. Look at the advanced decline line. Are more stocks rising each day than falling? A healthy bull market is characterized by broad participation. If you see the indices like the S&P 500 making new highs, but the AD line is diverging and making lower highs, this is a grave warning sign. It means the generals, a few large-cap stocks, are advancing, but the soldiers, the majority of stocks, are retreating. The army is weakening from within. Another crucial indicator is the number of stocks making new 52-week highs versus new 52-week lows. In a strong market, new highs will vastly outnumber new lows. When that ratio begins to shrink and then invert, the tide is turning. Third, you must identify the leading sectors. The market does not move as one monolithic block. It moves in groups. In a healthy bull market, the leadership will be in aggressive cyclical sectors: technology, industrials, consumer discretionary. Money is flowing into the areas of the economy that benefit from growth and optimism. If you see money rotating out of these groups and into defensive sectors, utilities, consumer staples, healthcare, it is a signal that the big money is becoming fearful. They are no longer betting on growth. They are preparing for a storm. Buying a high-flying tech stock when the utility sector is the strongest performer is like setting sail for a tropical vacation in the middle of winter. Only after you have confirmed that the general market tide is rising, that its internals are healthy, and that leadership is in aggressive sectors, do you earn the right to look for individual stocks. And you do not look just anywhere. You look for the strongest stocks within the strongest sectors. You are searching for the fastest ship in the fleet that is sailing with a powerful tailwind. This is how you stack the odds in your favor. This is how you move from gambling to intelligent speculation. Let us walk through a modern scenario. Imagine the market has been in a strong uptrend for over a year. The S&P 500 is well above its key moving averages. But recently you notice a change. The index makes a new high, but it does so on less volume than the previous high. The number of stocks making new highs is shrinking. The advanced decline line is flat. Meanwhile, you see that industrial metals stocks like copper and aluminum producers are starting to break down from their price patterns. This is a significant clue. These are the building blocks of the economy. If they are weak, it suggests a coming slowdown. At the same time, you've been following a pharmaceutical company. They have a breakthrough drug in late-stage trials, and the news is expected to be fantastic. Your research is thorough, and you are convinced the stock is undervalued. The temptation is to buy it now, to get in before the inevitable good news. But the general market is telling you to be cautious. The weakening of industrial stocks is a red flag. The divergences in the indices are another. The correct action is to do nothing. You wait. You respect the market's message. Sure enough, a week later, an unexpected inflation report spooks the market. The indices begin to fall sharply. The fear is palpable. And what happens to your pharmaceutical stock? It falls right along with everything else. The good news about its drug trial is now irrelevant. The market is in risk-off mode. All that matters is selling. By respecting the general market conditions, you preserved your capital. You can now wait for the correction to run its course and buy that same stock at a much lower price, once the market confirms it has found a bottom and is turning up again. You let the hurricane pass, and now you can inspect the ships that survived. Now, what if you find yourself on the wrong side of this equation? What if you have already made the mistake? You bought the stock, and now the general market has turned against you. The first rule is to eliminate hope from your vocabulary. Your original thesis for buying the stock might have been sound, but it was predicated on a cooperative market environment. That environment has now changed. Therefore, your reason for being in the trade is no longer valid. You must sell the position. Adhere to your stop loss without question. The initial small loss is your tuition fee for the lesson. To hold on, hoping your stock will be the one to defy the downturn, is to pay for that lesson with your entire account. It is not courage, it is financial stubbornness. Consider the alternative scenario. The market is in a clear downtrend, but you spot a stock that is refusing to go down. It is holding firm near its highs while everything else is collapsing. This is a sign of relative strength, and it is something to watch, but it is not an automatic buy signal. Often, these stocks are the last to fall. The large institutions that own them may be supporting them for a time, but if the market weakness persists, they too will be forced to liquidate. The risk of buying a stock in a bear market, no matter how strong it appears, is that you are stepping in front of a freight train to pick up a single coin. The potential reward is not worth the catastrophic risk. The professional waits for the train to pass. He waits for the market to turn. Then he can reevaluate that stock. If it is the first to make a new high when the general market begins its new upturn, then he has found a true leader. But he did not have to guess. The tape told him, your entire objective should be to align yourself with the dominant force. The path of a speculator is not one of a lone hero battling the consensus. It is one of a shrewd observer who identifies the most powerful current and flows with it. There is no prize for difficulty. There is no extra reward for correctly picking a stock that rises in a bear market. The far easier and more profitable path is to pick a good stock that rises in a bull market. You are there to make money, not to prove how clever you are. Let the market do the heavy lifting. Your task is simply to recognize when it is lifting and to place your capital accordingly. When it is falling, your task is to protect that capital by standing aside in cash. Sitting on your hands is a professional trading decision. It is often the most profitable one you can make. So, before your next trade, pause. Turn off the noise about your favorite company. Zoom out from the 5-minute chart. Look at the broad market. What is it telling you? Is it a calm, sunny day with a steady wind at your back? Or are dark clouds gathering on the horizon? Learn to be a market meteorologist first and a stock picker second. The tape tells you the story of the whole, not just the part. Your job is to listen, not to argue. Stay disciplined.